Hello, everybody. Hey, it's Mark Johnson here, and today's market recap for the week of October 20th is just hot off the presses. I've finally got all of my slides ready to go, and I wanted to just share with you some of the things that are affecting interest rates, your borrowing power, as well as like your buying power just at the pump, and the reason why inflation's going up, and a few things like that. So let's just jump in there. Last week, interest rates went up just a little bit over the week before. Last week it was 6.92. Today it's 6.94. That's the average 30-year Freddie Mac survey that they did with about just a little under 1 discount points. And you can see that it's just kind of tapering off right here. I think it'll still go up a little bit more from here. But again, we'll just have to watch that. Some of the things that affect the market right now is obviously inflation. We want to talk about that. These last year, the inflation figures were really low, 3%, 2% on a monthly basis. And then the last couple of, we were at 3% here, but if you look at this was 7% on a monthly basis. And then right now we're right about 6% on for August and September. So what this chart is showing that maybe we're starting to see inflation peak as well. So not only rates here, as well as possibly inflation as well. So let's go into what Fannie is saying here. By the end of the year, they feel like interest rates are going to be at about 5.7%. The Mortgage Bankers Association, they're telling us about 5.5%. And then Fannie Mae saying that, last August they made this prediction. So it might be a little bit off here. They're saying by March, we should be at 4.7%. So there is some good news on the horizon for those of you who are looking to buy homes. And I still think that even with this kind of market, it's still a good time to get in and buy a home because you're going to lock in your sales price today. Once we see inflation start to crest and interest rates start to come, you'll see a greater demand on the housing supply. And let's just talk about that for a minute. So right now, there's very little housing home buyer demand right now. It's collapsing, just very similar to the way it was, pre-pandemic. And so, it's right now is a great time if you're looking at buying a house because hardly anybody's looking. As well as some other things that I'm seeing here is that housing starts and permits are equally as low. We have household creations at about $1.6 to $1.7 million. And yet, what we're seeing is there's only units of completions of 1.43 million, which is way below what we need. Starts are 1.44 million. So those are down. Single family starts are really, really down by 18.5%, down to 0.89 million. And so what we're going to see here is, I believe, a continued demand for supply of homes, which will keep rates possibly, around the 4.5% rate is what I think it should have been all along, except for the pandemic. We needed to drop rates so we could keep the economy going. But I still feel like the real rate should have been 4.5% over the last 3 or 4 years. And I think it's going to get back down to that. But I think that demand for housing is going to stay really strong. And you're going to still have a hard time finding the house that you really want, especially when rates get down to 4.5%. You're better to go ahead and buy a house and lock in the home price today and maybe do a 2-1 buy down. So if your rate is 7%, you would start out at 5% until rates come down to 4.5 or 5.5% or something like that. So the way a 2-1 buy down works, or a 3-1 buy down, is you buy down the rate 2 to 3% for the first year, and then 2 to 1% the second year, and then 1% or 0% the third year. And of course, the fourth year, you're going to be paying, whatever the rate is. But we feel that interest rates are going to come down. And so a good way to, get lower payments right now, so you don't have that payment shock, is to do what's called a 2-1 buy down. I'm going to go over that in another video. So watch for that here. Let's look at existing home sales right now. Right now they're down on an annualized basis. They were slightly better than expectations, but they're still down 23%. And inventory, they're saying like, 3.2 months supply. Normal market is 4.6 months. But, those numbers are really incorrect. If you look at pre-pandemic, usually homes are, somewhere between closer to like 6 months is what they're on, is the amount of inventory right now. Nationwide, there's 732,000 active listings. However, 41% of those are under contract. So are they really available? I don't know. Probably not. One of the things that I thought was curious was job openings. You'll see that job openings and has changed significantly. Look at how fast they've come down. And that's going to change the way, if we go into a deeper recession here, and everybody's talking about, okay, finally there's a recession. Well, that's the leading indicator is you see job openings and then you start seeing layoffs going down very quickly and layoffs going up. So I feel like we're in a position where, during the next 3 to 6 months, there's going to be a lot of pain for many, many of our friends who are out there that maybe don't have really good, stable jobs, or who are, working in a situation where they might either get laid off or have their salaries cut. Let's go look at some of the things that are affecting what is happening with interest rates. So these are the factors that I thought I would just spend just a little bit about. Inflation, obviously, inflation right now goes hand in hand with mortgage rates. The higher the inflation is, the higher rates are going to go. And then when inflation comes down, and we've been blessed to have low inflation for about 10 years, then interest rates will come back down. World events such as COVID-19 and the supply chain economics that is crippling many countries, as well as the war in Ukraine, are reasons why interest rates are going up. Economic crises, so many of the countries right now, and Britain's just reeling from that. I guess they fired their prime minister, and so those are things that affect, our dollar versus other dollars, and the supply and demand of money is out there. Then you got personal factors that obviously affect your rate. So pretty much what we look at is credit scores and debt to income and down payment. Those are the three things that really affect your credit scores. There are other things that affect it too, but those are the major ones. Things such as, where you live, the loan amount, and obviously those will affect it too as well. And then the Federal Reserve also, like they're talking about raising interest rates still another 1.25%. So I believe they'll probably raise rates 0.75% when they meet in 2 weeks in November. And then I believe they'll meet in December again, and they'll raise it another 0.75 for a total of 1.25% total increase. And they might even raise it again if they're not seeing the decline in inflation like they want to see. I believe they'll see it, but it's hard to say. Let's take a look at the charts for just a second here. If you notice here, the bond market, this is the bond market right here, and it's coming down. Now, what that means is actually interest rates are going up. It's the inverse of what interest rates are doing. And you'll notice there's a strong ceiling of support here. Hopefully, this is going to be a bottom support line right here. Several days ago when the rates were just going crazy, it hit this and then it came back up and it stayed right here. And then yesterday and today, things have gotten worse. The same thing is for the 10-year treasuries. If you look at the treasuries now, we've kind of gone above this ceiling here, which means, there's a little bit more that it could go up to as well. So we could possibly see interest rates during the next week go up to as high as possibly 7, maybe 7.05 or 07, something like that. Stay tuned. I'll publish those next week, same time, same place here on our YouTube channel, as well as on Facebook and Instagram, and wherever you're at, I'm going to be there. If you have any questions on this, please, shoot me a DM. If you want my newsletter that has all of the charts on there, go ahead and shoot me your email address, and I'll put you on my email campaign as well. All right. Have a great day. Thanks for listening.